weekly Nasdaq 100 chart. We have drawn a trend line that goes back to 1999, where we had a huge breakout back in those days, and we got right up here toward the highs of 2000. And what I'm trying to show people is this is where the breakout level was at 2406 back in this time frame. The other thing that I want to be direct is that when you see the 2001 area right here and that same trend line, this is where that 2001 reversal handle happened and occurred to fall at that point in time. Now, when we get back over here in the 2011 and 2012 period, as we are, is that same trend line is the same trend line that goes way back in those multiple years that I just showed. And this is the upper end of that weekly trend line on the Nasdaq 100. We do have other areas that can be tested, and this would be 2371. It's certainly possible. However, in an 8-day trading period and a beginning bull 2012 weekly, 4-day weekly, and we had Christmas, which is 4 days. That's 8 days. That's where your biggest movement started over here, from here to here, but then has continued from the top of this. So that's going to be the short-term support level. It gapped above it during this week of 4 days. Now, granted that it's got a bull signal on it, the short-term macro says that just like being oversold or being overbought, they can run in cycles. But the one thing that concerns us for the bull is that you did not break up on above average volume or on balance volume was not what you would want to see in a 4-day week. And granted, you had great numbers and everything, you still had some selling going here, and you still had a little bit of drawdown here, nothing big. And the tech heavy sector has been leveraging up, and it's a mixed bag in this area. However, when you take a look at the amount of short-term consecutive weekly highs on light volume, it suggests that you would have the pullback, because another thing is the 10-week moving average is still declining and sloping lower, which always suggests that the lighter on balance volume in a weekly move being walked up is that you will come down and you're going to test this area in here during your earnings season. And that the bull side of it is that the rising 20-week is going to give this area at the first pass of support level. We're going to have to deal with Europe. We're going to have to deal with the earnings season. Family Dollar was down big today. Other things like retailers were down. Some were up during the week, but we're not blowing out. The bull is exuberant, but not totally out of control. It's a light volume movement with declining 10-week moving average below the 50-week. As we move forward, I still believe that the imbalances of the short-term call and put ratio are out of whack. And the only time that you find when put and call ratios get really out of control is either when there's very high level of fear in the market, when the VIX and the VXN is at high levels, and or when there is very, very less fear in the market. And history shows that on the VIX on a weekly level, what I'm talking about is that the lower that this fear level goes here on the weekly level, that means that the bull side of the market's been working for 1, 2, 3, 4, 5, 6, 7 weeks. But a couple of these weeks were the holiday right here. And that the VIX is going to come down to complacency levels, and it can come down to 1761 still. but we're going to get down to levels where markets will change in calendar 2012. We've had 4 trading days. So that is the VIX overview. The other major overview that we're going to talk about is this S&P 500 overview. I'm going to what I'm going to do is clear these trend lines for you on the first pass and just let you see it. That's right up here at that top. Yes, they have a slight weekly buy signal that was created in 8 days of the Christmas week and the New Year's week that we're just completing. Now the holiday and the New Year is officially over of the first 4 upside trading days of the new calendar 2012. And that these bullish cases is that we're above here, but it would not take long to wipe them out during the upcoming earnings season. And any noise out of Europe with that FXE down at 127 and the short-term imbalance directional movements say that there's a pullback coming, and that you want to be aware of that pullback when it does come, because until you can clear the weekly resistance level, we should have, I can tell you what, if the bull was really in this market, see this resistance level right here, we would have blew through that going in this direction from here. When we came up here, we would have never looked back. And right up here, when the closer to the top of that resistance area that you get, if that buyer's really there in this 8-day period, you know, it's a weekly calendar 2012, here it is. But in the last 8 weeks, you would have blew right through there. And you would have came right up here already. Right here. And these are the levels that we talk about. And we also talk about levels right in here. Slightly before there, right up here at that 1300 handle, where that the upside volatility was to get up here and even as high as here. But we're going to have to deal with the earnings seasons. So I would say that this move here with the kind of companies, if we start next week's trading and we start with the sale program and we get below this weekly calendar 2000 weekly low right here, and if we gap down below here and that would become new resistance, then we know that we would be going down this way to the lower channel. So it'd be right here, see, and I'll just draw you a trend line. It'd be right there, and you would be trading in this range. So you would come down to this trend line right here, and this would be your support level. If the 10-week, this blue line rolls over, then the upside at resistance should hold. The way that we see the market moving forward after the 4-day trading range of the new year is that we don't believe that everything is out of the way yet, and that there are markdowns, and this is the closing bell right now, 1:15 p.m., 1/6/2012. Any problems out of Iran, and this is what the investor faces, is that any major guidances in the earnings season out of bellwether companies guiding down the quarter, it's going to change this whole little bull rally here from this level is at risk. And that's from here to there. And that's this whole area right in here of the last 1, 2, 3, 4, 5, 6 week period. This is this whole area. So there are a lot of headline risk that will stay on top of the investors. The fundamentals is that we don't see where the current earnings cycle in calendar 2012 January will start on Monday. Then the following week on the 17th, they'll be in full bloom. And we don't see in the cycle where that those earnings would continue to top above the bar level to continue a huge rally that would be sustainable in the first 2 quarters of 2012, meaning that there will have to be in certain sectors that have fallen weak GDP at the lower level is that GDP is going to have to get re-leveraged up. So if you're between 1.5% and 3%, or at best 3.5% in a calendar year, that's not enough to create jobs and move a bull market forward. It's just not a sustainable bull market. What happens is they're great for trading ranges and then failures. This is the calendar New Year. Happy New Year's to everyone, because now our holidays are over, and I hope everyone had a great Christmas, because now the rest of the year will start Monday. And we're out of that seasonality period, and we're going to be looking for deals, but we see a lot more headline risk to the investor and people that hold overnight in the first couple of quarters, or the first, at least 2 quarters of the year. And we see that the European debt crisis has got to get a total Q3 injection from Ben Bernanke, and the European system banking model will have to inject at the same time, which at some point in time would create a great bull rally when we get into this part of this calendar year. So what we look for is to get all the bad news out of the way and get the earnings, take advantage of the January and the first 2 quarters, or the first quarter at least, is to get these earnings estimates revised downward to meet the current growth environment, so that when we do get in the middle of the year, that with the earnings taken down, companies could grow at that moderate growth rate of a lower growth rate. So you got lower moderate growth until that would re-leverage up, and we don't see that happening until later in the year. Now, if we go to war with Iran and things start getting a little bit more funky and some of the banks blow up and they can't contain it, and I didn't say banks in the U.S., but banks overseas, well, that would create the scenario of the two things that you would want to have happen. And what we're looking for is, number one, clear the Europe mess out of the way and get the earnings estimates revised down, get the negative guidances out of the way in the first 2 quarters of the year of 2012. And we're going to be in trading ranges. Not only that, moving forward in 2012 through the rest of the calendar year of January, you will start to see increased volatility in the price. And yes, we had where trading indexes and whatnot, you'd have 300-point up days and 400-point down days, and when the volatility was higher, we're running 200-point days in the Dow and all of these various different kinds of things. That price volatility is coming again. And that's another thing that the investor will get hit upside the head with. And even the professional community that call them the greatest, they can't hardly deal with it because they haven't seen it. And we had a very good dose of it the last 6 months. We're not out of the woods. So the way that we see our strategies is that our strategies is to mark down assets, mark down the negative, get the negative out of the system, and then why that is happening is that you would be making money on the short side of the market. Then you would be making money later on as all the negativity clears out. The bull side would come back into the market. So this calendar, 4-day calendar trading range of 2012, being 1/6/2012, is not what we're looking for. That S&P would have been much higher. and we would have already been back up to the 1320 neckline. No one says that they're not going to keep trying to run it up. Earnings season starts Monday. They're going to be light next week, but they will be full blown the week thereafter. What I have said and continue to say, that in the first half of the year, it's better to sell into the rallies and look for the deals after they report, and make sure that you're not in harm's way if you're a buy and hold investor. If you don't know how to work those reports, earnings after hours, and what the company's going to say, best thing for you to do is take your gain and get out of the way. Sit on the sideline until your companies that you like, once they report, then you can go in and do your homework and figure out what you need to do from there. That's the way we'll be doing it here. Same thing for you. So I'm going to conclude the fact that the S&P did not break up. I'm going to conclude the fact that the Dow Jones has now officially also, on a weekly level, has come right back up to the neckline that we said would be resistance. That's this area right here, back in this time. And when was that time? That was back on 710 when we called, and you went from 710 when we were shorting up here at the highs. That's a 4-week resistance level, and bam. And bam. Of course, it's 2011 is gone now. But remember, that low is over here now. And this high from there to there is being challenged, and this is that area right here on the Dow. Be aware. Another thing on this Nasdaq 100, which I just showed, we know where our top line is, and we know that this is going to be the major area, and we're coming to that first phase of where this last reversal happened in calendar 2011. 2012, well, we're not quite sure, other than the resistance levels are coming up, and here's the Nasdaq Composite testing its 50-day moving average. But once again, the Nasdaq Composite doesn't look well. Why is that? It's because of that on-balance volume and the rate of change between the on-balance bull volume. The bull has an on-balance volume. The bear has an on-balance volume. They both have a trade management that is used, and if you need to find out more about that, well, we're here to help you. Just come see us. That 50-week moving average right here, this is calendar 2012. Happy New Year for the Nasdaq Composite, and Happy New Year for that bull rally, but let me show you that blue line is still declining. That's not good. I would much rather see in any bull rally where that blue line, the 10-week, is always going up in value as you're being taught. So the buy and hold person, investors, 401ks, listen, there's going to be a lot of volatility coming your way. And it's like all the time. It's just like when we called it back up here at the highs. We knew that they were walking it. We knew that this was going to happen over here because we have all the live trades and all the live videos to prove it. Type in indexes on Nasdaq Composite, and technology led the way. Now we're right back up here. Welcome to the calendar year. They do not have a weekly buy signal. They're trying to push it in that direction. Earnings are going to have to show up. Be aware. First calendar, I've just covered all of it for you, and we'll leave it at that. And then the last thing that will show is the tech-heavy and semiconductors is, yes, these are the all-time tops, and we have walked up on very, very, very light volume. And that's not what bull rallies are. Bull rallies are people buying on above average balance volume. And the rate of change starts, the on-balance volume concerned, it shows the direction. And I don't like the fact that when you look over a long, long period of time, is that I'm not seeing that bull side volume. And I'll leave it at that. Beware.